Inventory management. Inventory management refers to the process of ordering, storing, and using a company's inventory. These include the management and supervision of raw materials, components, and finished products, as well as warehousing and processing such items. ABC analysis. Typically, a company has thousands of items held in its inventory. However, only a small percentage of these items deserve management's closest attention and tightest control. An ABC analysis is the process of dividing the inventory units into 3 classes according to their dollar usage so that managers can focus on the items with the highest importance. Class A items.
These items typically represent 20% of the items in the inventory but account for 80% of the dollar usage.
Class B items.
These items represent 30% of the items in the inventory, but only account for 15% of the dollar usage.
Class C items.
These items represent 50% of the items in the inventory, but only account for 5% of the dollar usage.
The ABC classification gives recognition to the varying importance of different types of inventory. Consequently, classifying items into A, B, and C allows management to better identify and control items of greater importance. Loss of control over a few Class A items is considerably more serious than the loss of control over a large number of Class B or C items. Reorder point model. The reorder point model identifies the time to order when a stock level drops to a predetermined amount. This amount usually includes a certain quantity of stock to cover for the delay between order and delivery, the lead time, and stock to reduce the risk of running out of stock, the safety stock. The reorder point model permits you to calculate when you need to make a new order to not run out of stock and minimize inventory and stocking costs. The 2 main elements of the reorder point model are lead time, the interval between placing an order and having it ready for dispensing. When calculating lead times in a supermarket, for example, you must also consider the amount of time to stock the shelves. Safety stock, the extra units of inventory carried as a protection against possible stockouts. The safety stock must be carried when the manager is not sure about either the demand for the product or the lead time. The thing to know about a reorder point is that it's not a static number. It's based on your own purchase and sales cycles, and it varies on a per-product basis. However, once you have a handle on patterns in your purchase and sales orders for a particular product, you're ready to start putting the variables together. The reorder point is the inventory level at which it is appropriate to replenish stock. The calculation for this is as follows.
Reorder point equals average demand during lead time plus safety stock.
The reorder point can also be displayed graphically. You can see that the reorder point depends heavily on the lead time. The longer it is, the earlier the new purchasing order should be placed. So the order cycle can be pictured as follows. There are several methods that companies can use to control or manage inventory management, including FIFO, first in first out. This method is a way of determining the ending inventory value based on the assumption that the items purchased first are the first to be sold. Therefore, the items in stock are considered to come from the most recent purchases, as items from earlier purchases are assumed to have been sold. Here are some benefits of the FIFO, first in first out method. 1. Widely accepted. This method is internationally recognized and aligns with international financial reporting standards, making it a popular choice in many organizations. 2. Easy to understand. Its process is logical and straightforward, making it easy to implement for various types of businesses. 3. Reduces income manipulation. It facilitates transparency in financial reporting, thereby reducing the likelihood of manipulation. 4. Cost and time efficiency. It reduces the time and cost required to estimate the cost of goods sold. Implementing the FIFO method requires good warehouse layout management to ensure that older items can be accessed first. Different colored FIFO labels for each month are used to make it easier to identify new and old items. This method is very suitable for items with expiration dates, perishable goods, and items with fashion trends. LIFO, last in first out. Conversely, the LIFO method prioritizes the most recent, newest items to be sold first. The newly received items will be sold or used before the older items. Here are some benefits of the LIFO, last in first out method. 1. Tax savings. In inflationary conditions, LIFO allows companies to recognize higher costs as the cost of goods sold, which can reduce taxable income. 2. Matching cost. LIFO matches the latest costs with the latest revenues, providing a more accurate picture of current profitability in rising price conditions. However, LIFO can be more complicated to manage and requires sophisticated systems for accurate tracking. Older items may remain in stock longer, increasing the risk of obsolescence or expiration. Some countries, such as those in the European Union, prohibit the use of LIFO, as it is considered not to reflect the true value of inventory. The LIFO method can be very useful in certain conditions, but its use must be tailored to the applicable needs and regulations. Business decision management. Business decision management entails all aspects of designing, building, and managing the decision-making systems that an organization uses to manage its interactions with customers, employees, and suppliers. In this chapter, you will learn to use two of the most popular decision-making tools: break-even analysis. Operations managers have to make many decisions as they manage production processes and supply chain. The break-even analysis helps managers to identify how much change in volume or demand is necessary before a second alternative becomes better than the first alternative, to evaluate an idea for a new product or service, or to examine the performance for an existing one. The break-even analysis comes in handy. The break-even quantity is the production volume at which total revenues equal total costs. Computation of break-even points is very important for every business, because it tells business owners and managers how much sales are needed to cover all fixed as well as all variable expenses. It tells exactly at which sales volume the business will start generating profit. Since we want to know when total costs equal total revenues, we can use the following formula.
Total revenue equals total cost.
To carry out a break-even analysis, however, we need more information about the costs of producing a product, as well as the revenue that are generated selling a product. The total cost is typically split into fixed cost and the variable cost. The variable cost varies directly with the volume of production, i.e. cost per unit for raw materials and labor. Fixed cost does not vary with the volume of production, i.e. facilities, machines, advertising budget. Total revenue is simply the amount of money a firm receives. If a firm is selling each unit at the same price, then total revenue will equal price times quantity. This leads us to a more precise expression of the formula.
Price times quantity equals fixed cost plus variable cost times quantity.
Since we are interested in the break-even quantity, we can change this formula using basic algebra.
Quantity equals fixed cost divided by price minus variable cost.
Decision tree. A decision tree is a schematic model of alternatives available to the decision maker, along with their possible consequences. It is a map of the possible outcomes of a series of related choices. It allows an individual or organization to weigh possible actions against one another based on their costs, probabilities, and benefits. A decision tree method is a general approach to a wide range of processes and supply chain decisions, such as product planning, process capacity, and location. It is particularly valuable for evaluating different capacity expansion alternatives when demand is uncertain and sequential decisions are involved. A decision tree typically starts with a decision which branches into possible outcomes. Each of those outcomes leads to additional decisions which branch off into other possibilities. This gives it a tree-like shape. There are 3 different types of nodes: decision nodes, event nodes, and end nodes. A decision node, represented by a square, shows a decision to be made, and an end node shows the final outcome of a decision path. An event node, represented by a circle, shows the probabilities of certain results. An end node, outcome, shows the final outcome of a decision path.
Yes, see you on
Feel
the
okay?
top.
Feeling good?
Okay, see you on the top.
Yes.